Welcome to Talk Tickers. Today, we're digging into M&T Bank's latest earnings report for Q4 2025. Now, on the surface, the numbers look great. They beat expectations, but the stock's reaction was, well, not what you'd expect. Let's break down exactly what happened.
So, M&T Bank, ticker MTB, they dropped their Q4 numbers, and the headline was a GAAP earnings per share of $4.67. That's a solid 20-cent beat over what Wall Street was looking for. A really clean win on the bottom line.
So you'd think the stock would pop, right? Good news equals a higher stock price. Well, not exactly. In pre-market trading, right after the results came out, the stock was actually down about 1.7%.
And that brings us to the big puzzle we're going to unpack in this explainer. The quarter was strong, so why did the stock sell off? This is one of those classic market mysteries, so let's get into it.
Okay, first things first. Let's just establish how good the quarter that just wrapped up actually was. Because when you look at the headlines, the results were, without a doubt, very positive.
I mean, just look at this. You've got the EPS beat right there at the top. But it's not just that. Their net interest income, or NII, came in hot at almost $1.8 billion, easily topping estimates. And their non-interest income? That was up a healthy 6% from last year. So by pretty much every measure, this was a very, very solid quarter.
But here's the thing you always have to remember about the market. Smart money, the big investors, they almost never trade on what just happened. They're constantly trying to look around the corner to price in what's coming 6-12 months down the road. And that's where this story takes a turn.
And this quote right here, it just nails it. The market basically shrugged off the great Q4 performance and immediately started laser focusing on management's guidance for the future. So what exactly did they see that they didn't like?
It's like this classic Wall Street story, right? On the left side, you've got all the good news from the past. A fantastic Q4, a record year for income, and the bank returning a ton of cash to shareholders. But on the right, you see what the market is worried about today. The outlook for 2026, where net interest income is headed, and the risk that credit costs are going to start creeping up.
So before we dive headfirst into the guidance that spooked everybody, let's just spend another minute on what made Q4 so strong. It's important to understand the high bar they set for themselves because that's what the market is now getting nervous about. The absolute powerhouse of this quarter was their net interest income, clocking in at a massive $1.779 billion. This is the bank's core engine. It's the money they make on loans minus the interest they pay out on deposits, and it was firing on all cylinders.
And that strong income flows right into their net interest margin, or NIM, which stood at a very healthy 3.69%. Think of this as the profit margin on their main business of lending. It tells you their core operations are still incredibly profitable.
Now this number is all about confidence. Management bought back over $500 million of their own stock in just 3 months. That is a seriously aggressive move, and it's a huge signal that they believe the company's shares are a great investment.
Okay, so the quarter was great. We've established that. But now we get to the heart of the issue. Let's pull apart the forward-looking guidance for 2026 and really see what's making the market so jittery.
Right, here's the outlook. And you can see why the mood changed. Look at net interest income. After a record year, they're guiding to a range that suggests growth is going to slow way down, becoming pretty modest. They see their net interest margin getting squeezed a bit into the low 370s. And look at net charge-offs. They're expecting those to rise as credit quality normalizes, which is just a nice way of saying more people might have trouble paying back their loans. None of this is a disaster, but it's a very clear signal that the boom times are slowing.
So let's just boil this all down. What's the takeaway? 1, that powerful NII growth engine is sputtering. 2, their whole forecast is based on the Fed cutting rates by 0.5%, which, adds a layer of uncertainty. 3, costs are going up. And 4, they're going to keep buying back stock, but a lot of that is just to get their capital levels down to their target, not necessarily to create a ton of new value. These are the headwinds that the market saw and immediately started pricing in.
All right, we've seen the fantastic quarter they just put up, and we've dissected the cautious outlook for the year ahead. So, the big question is, how do we put all of this together and come up with an actual call on the stock? So here's our call at Talk Tickers. We are rating M&T Bank a market perform. What does that mean? It means we think the stock is likely to perform right in line with the rest of the banking sector. Not a huge winner, not a huge loser. And here's why.
It really breaks down into 3 pieces. First, their Q4 execution was just excellent, but that's old news now. It's already in the stock price. Second, the 2026 guidance is stable, yeah, but it's cautious, and that's going to put a cap on how high the stock can go in the near term. But the big positive, the thing that keeps us from being more negative, is that aggressive capital return program. That should act as a really strong safety net for the stock price.
Okay, so that's the official rating. But let's go one step further. How could you actually play this kind of setup? Let's talk about a potential trade idea that an analyst might consider.
The core concept here isn't to make some huge bet on whether all regional banks are going to go up or down. Nope. The goal is to isolate what we see as a best-in-class operator, M&T Bank, and bet on them to outperform their peers, even if the whole industry is facing some headwinds.
So here's how a hedge fund might look at this. It's called a relative value pair trade. Step 1, you buy or go long M&T Bank stock. Step 2, you short sell an equal dollar amount of the regional banking ETF, ticker KRE. So what's the logic? You're betting that M&T's superior execution and those huge buybacks will help it do better than the average bank. By shorting the ETF, you protect yourself from the sector-wide problems, like margin pressure. It's a bet on relative performance, not absolute direction.
And as always, we have to close with our most important reminder: this is not financial advice.